Hi, everybody. Thanks for watching. My name is Matt Frankel. I am a certified financial planner. Before we get started, please hit subscribe to my channel to keep up with all of my latest investing and personal finance content. And please check out the link you see on your screen for a special message from our sponsor, The Motley Fool, where you can get the top 10 stocks to buy right now. So, if you've just gotten started investing, you're thinking about doing so, congratulations. Investing in stocks is a great move. It's a great way to build life changing wealth over time. The stock market has been responsible for creating millions of millionaires throughout the world over time, and it can be do the same for you. But it's really important when you're getting started to avoid some of the major mistakes that newer investors make. Now, a lot of these mistakes you can recover from. I've certainly made a few in my investing career, but it's better to learn from investors who have done them and know what to look out for and know what to avoid. So I want to go through seven of them in particular. So, number one is don't think short term. It's really a losing battle to try to time the market. Don't look at a stock and say, okay, this one went down from 10 to $8. I'm going to buy it and I'm going to sell it as soon as it goes back to 10. That's a losing battle. It's a terrible way to try to make money. Nobody knows what a stock is going to do short term. Day trading is an especially dangerous way to try to invest. Leave that to the professionals. The professional traders at firms like Goldman Sachs have much better technology than you do, and they will leverage that to make money off of people who don't know what they're doing. So the best way to invest is long term, period, the end. Don't try to time the market, buy a stock because you want to own it for years to come, not because you want to own it for the next few days or weeks. Number two, try to avoid investing in businesses you don't understand. My general rule of thumb, even as somebody who's been investing in the stock market for 20 years, is if I can't explain what a company does in one sentence, I won't invest in it. So it's smart to invest in businesses that you easily understand. A bank, for example, is a relatively simple business. It loans out money and pay and takes in consumer deposits and profits from the difference in the interest rates it pays. Something that can be explained that easily in one sentence is a great way to start investing. Um, as you go, you can learn more about the industries that interest you, and you can kind of expand your universe of stocks that you understand. But it's really important not to invest in companies that just totally confuse you, just because somebody else invested in them, so because you saw them talked about on CNBC or whatever. So that's number two. Number three, don't chase cheap stocks. A lot of stocks are cheap for a reason. And this is especially true when you see stocks that have really low price tags. Be especially wary of share prices below $5. Now, there are some in that range that could be good, especially in a bear market like this, but stocks that are down by 90%, stocks that are, trading for 75 cents a share, a lot of those are kind of broken business models and have a real risk of going to zero. It's entirely possible, and this is something that new investors forget from all the time. It's entirely possible for stocks to go to zero. You can lose all of your money if something doesn't go well. So, a good way to avoid that is not to try to chase stocks just because they are cheap. The right kind of cheap stocks to buy are companies that are trading cheaply relative to their intrinsic value or relative to their potential, not just that have low share prices or have come down a lot. Number four, and this is a cautionary tale I can share from my own experience. Number four is don't sell too soon. One common misconception among newer investors, even those who have a long term mentality, is that there's nothing wrong with taking profits from your winning investments. If a stock doubles, say, well, there's nothing wrong with cashing out now. But that's not true. It can be a good way to, well, you'll get a short term payday, but it can be a good way to leave a lot of money on the table. And I'll give you my example. In about 10 years ago, I invested in Tesla shortly after its IPO. My cost basis in the stock was, if you adjust for splits, about $3 a share. About a year later, Motor Trend named the Model S its car of the year, and the stock roughly tripled. And I sold it to take the profits and use it for things I needed to spend money on. Um, If I had held on to my initial Tesla investment, which cost me about $1,000 at the time, or $2,000 at the time, it would be worth about $500,000 today. So obviously, you can't think retroactively, and people sell stocks for a variety of reasons. And I sold it to in part pay for my wedding, so I can't make the case that it was a terrible thing to do. But I did sell too soon. It could be a great if the original reasons for buying a stock still apply. You should really, really think twice before selling, even if it went up quite a bit. So, cautionary tale there. Number five, know how to move on when you're wrong. The other thing side of selling too early is holding on too long. So, if a stock doesn't do what you think it'll do, not necessarily the share price, but the business itself, think of the initial reasons you bought the stock. If you bought it because you thought the business was going to, double its customer base over the next couple of years, or because you thought its profitability would grow over the next few quarters. If it doesn't do what you think it will do, it can be a good reason to reassess and see if you're better off deploying that money elsewhere. So, one mistake that new investors make a lot is doing what's called averaging down, meaning that they continue to buy more shares on stocks that are falling no matter what, with the idea of lowering their average cost per share. If the business is doing well and the stock is beaten down regardless, which is quite common in the market today, in the current environment, it could be okay to buy more shares. But don't buy more stock just because it went down. If your original investment thesis isn't working out, then you're just doing nothing but throwing good money after bad. And that's something that new investors should really strive to avoid. Number six, avoid rash decisions. So it's common knowledge that the goal of investing, the general goal, is to buy low and sell high. But our instincts tell us to do the opposite in certain situations. When we see stocks plunging, bad earnings report, your stock goes down 20%, it's our instinct to panic and sell before things get any worse. On the other hand, when you see stocks going up and up and up and everyone else is making tons of money on them, it's our instinct to put our money in so we don't miss out. So this is actually, both of those situations are literally the opposite of buying low and selling high. You're either buying high and selling low, or you're just buying high and then holding on and hoping it gets even higher. So before you make any rash decisions, either buying or selling, make sure you take a step back and do your due diligence and have a really good reason as to why you're selling. And just because a stock went down isn't a good reason to sell. Just because a stock is going up and up and up and has a lot of momentum isn't by itself a good reason to buy. And number seven, finally, don't treat the stock market as a casino, especially if you're trying to invest for the long term. There's nothing wrong with doing a little bit of speculating if you understand that that's what you're doing and you're prepared to lose every penny you're putting into the stocks. I own a few speculative stocks myself with the understanding that if things go wrong, they could go to zero. It's a very small portion of my portfolio and it's a very manageable portion. And I know that I'm speculating with that money. The problem is when people can confuse a speculative bet, which is what investing in a high risk stock is. It's a bet. Don't confuse a speculative bet with a solid long term investment. Those are two completely different baskets of stocks. Once again, thank you so much for joining me. Be sure to click subscribe if you don't subscribe to my channel already. And as always, this video is sponsored by The Motley Fool. Be sure to visit www.fool.com/Frankel to receive the top 10 best stocks to buy now.